Welcome to Inside the Deal. I'm Suzanne Stevens. With me today is Jess Varughese. Jess is a managing partner with the financial services management consultancy Milestone. Jess, we talked to you recently for an article in the Deal News Weekly called Making Megabanks, where we looked at some of the integration issues facing these big banks that are coming together. Certainly one of the biggest deals is Bank of America and Merrill Lynch, and one of the issues there is Bank of America trying to hold on to these Merrill Lynch bankers. And we've seen estimates that as many as 20% of Merrill bankers could bail on Bank of America because of retention bonuses or other issues. Are you surprised by a percentage that high?
Not really. I think retention bonuses are just one aspect of keeping attrition low. But what we're seeing going on in the industry is just a fundamental structural shift in the business model of financial services. And we're seeing some impact here, some of it real, some of it perceived, in the form of lower leverage, in the form of much tighter usage around capital, in terms of tighter regulation, and in terms of potentially less innovation as a result of much higher levels of risk management. So there was a perception there that this could lead to less innovation and therefore lower returns and therefore lower compensation. So it's no surprise. Now, 6 months ago, in anticipation of a pretty rapid consolidation of the financial services industry, we put out a white paper called The 10 Commandments to a Successful Integration. And there are several factors in there that could help in retention, such as picking your leaders early, empowering your leaders, balancing your leaders between two companies so you send a strong message that this is not a takeover, it's more of an integration. Being very, very clear about your business vision, articulating your business vision in a way that makes sense to the rank and file, and communicating that relentlessly. So in addition to retention packages, these are the tools that these acquiring firms can use to retain talent.
Well, a similar situation is happening with Barclays and Lehman Brothers. And Barclays is already seeing some exodus of Lehman Brothers bankers going to other places. Now, how much does that hurt Barclays' ability to really get the value out of this deal?
Well, I think it's hard to not get value out of the deal based on the deal price here.
The situation at Lehman was pretty drastic.
Exactly. Yeah. So this was a fire sale deal. But again, the leaders of these acquiring banks are incredibly strong, aggressive people who are not going to rest on their laurels, and they're going to want to chase every synergy dollar that they can eventually. But in terms of immediate pressure to realize value in the deal, the deal price being what it is, I think they've already realized value. In terms of attrition and how that impacts value, yes, that's going to cause a significant impact on value if you can't control your levels of attrition. So it goes back to some of the 10 Commandments here around picking your leaders. And I think there's a very, very important part around the communication, which is taking the business vision down to almost the individual and convincing the individual talent that you're trying to retain that there is a very profitable personal business model for that individual in the merged organization.
One merger that we've seen that's moved much further along, and the integration is probably almost complete, another file show certainly, is JP Morgan's purchase of Bear Stearns. And I'm wondering if there are any particular lessons learned from that integration that could apply to some of the banks coming together now.
Well, JP Morgan has certainly done many of these integrations. Jamie Dimon is a master at integrating companies, and if anybody has the playbook, it's JP Morgan. In terms of lessons learned out of the Bear Stearns integration, I think the way the leadership team was constructed for the investment bank showed a very, very strong focus on picking the best of breed. It sent a very strong message to the Bear Stearns employees that their leaders were going to be empowered in the new organization and that this was clearly going to be an integration. They also dealt with cultural differences with a lot of sensitivity. An example would be merging the brokerage business into the private wealth management group at JP Morgan Chase, the brokerage business of Bear. They didn't rush to harmonize compensation models. The models were very different. Bear had a very entrepreneurial, aggressive compensation model. What they did, though, was very clearly articulate a very expanded product suite that JP Morgan Chase brought to Bear and how that would basically impact the Bear brokers' ability to grow their businesses with their existing clients.
What we're seeing here kind of broadly is a universal banking model taking hold, at least among the bigger banks in the U.S. To kind of close this out, Jess, I'm curious, what are your thoughts on, is that a viable model for the American banking system?
Well, what we've seen is about 20 years worth of change occurring in about 30 days in terms of consolidation, and probably the fastest creation of an oligopoly of banking in history. Is it good? I think it's a short-term and a long-term answer here. In the short term, it was necessary and therefore it was good. You had an incredible amount of fragility in the financial services system that needed to be addressed, and there was a consolidation to balance sheet quality here. In the long term, I think the jury's out. The impact on the consumer relative to competition, relative to pricing, relative to innovation, these are all questions that need to be answered, and I think the jury's out on that.
Jess Varughese with Milestone, thanks so much for being with us.
Thank you very much.
I'm Suzanne Stevens. Thanks for watching Inside the Deal.